Welcome to Counters. In this lesson, we're going to be looking at accruals and prepayments. We're going to explain what they are, how to identify what it is, and go through some examples of completing journal entries in relation to accruals and prepayments. This is the fourth lesson in our series on accounting for beginners. In the first lesson, we looked at the accounting equation in great detail. In the second one, we looked at the journal entries or the general journal. In the third one, we looked at the general ledger. And here we are looking at accruals and prepayments. And this one here, you will see how it relates to the other lessons we've been looking at. So if you have not looked at the other lessons, I would strongly encourage you to look at the other lessons before looking at this one. You'll find them in the links in the description below. So we're going to focus on how to account for accruals. And this is based on some accounting principles that we need to bear in mind. And the first one we're going to look at is the accrual principle. This principle states that regardless of cash movements, transactions must be recorded in the accounting records and shown in the financial statements in the accounting period in which they occur. So it's regardless of cash movement. You have to account for them in the period in which they occur, regardless of cash movements. And the second principle we're going to be dealing with is the matching principle. And this principle states that income earned and the related expenses incurred must be disclosed in the same accounting period and financial statements. So obviously, as we earn an income, we know that we are also incurring expenses for those income during the same period. Okay, so we have to disclose them in the same accounting period and financial statements, and that is what we are guided by. Okay, now that we have seen the two principles that we'll be dealing with, what are the accruals and prepayments? Well, here they are. The first one we have is prepaid expense. The second one we have is income received in advance, otherwise known as deferred income. The third one we have is accrued expense, and the fourth one is accrued income. So we're going to go through some examples in how to identify which one we are dealing with in a specific example and how to do the journal entries for these four. So let's start with the first one, prepaid expense. What is that? Well, prepaid expense is an expense that is paid for in the current financial year, but the whole or part of the expense concerns the next accounting period. So like the word prepaid suggests, you are paying for something in advance. It's an expense that you have not incurred yet, but you are paying for it in advance. And that is exactly what it is, prepaid expense. You know that you will incur some expense in the future, but you're paying for it right now. So you have not incurred that expense as yet. The second one we have here is income received in advance, otherwise known as deferred income, as I've just mentioned. This is cash that has been received in advance for a product or service that has not been provided. As such, the income has not been earned yet. Okay, so what's happening here is that your customer or your client is paying for a service or product that you have not provided yet. So it's an income that has been received in advance, or a deferred income. So you have the money as the company, but the money does not belong to you yet because you have not provided the service or the product to the customer. I hope that has made sense, but we're going to go into it in more detail as we look at the examples. The third one we have here is accrued expense. Accrued expense. What I like to mention here when I'm dealing with accrued is to say, if you can replace the word accrued with the word still outstanding, then maybe that can give you a better understanding. So accrued expense is an expense that you have already incurred during the financial year but has not yet been paid. So you have incurred this expense, but you've not paid for this expense as yet. That's why I use the word still outstanding expense. Okay, you have not paid for it yet. So you have incurred it. So that means you owe that money for that particular expense, but you've not paid it as yet. Accrued income, like the word accrued, I like to replace it with still outstanding. So it's still outstanding income, meaning you have earned the income during the financial year, but it has not been received as yet. Okay, so accrued income is an income that you have earned as the company, but the customer has not paid the company as yet. And this is what they mean. So as we go through the examples, you should be able to pick up which one we are dealing with. Now, what are they? Are they assets, equity, or liabilities? Remember, as we looked from the first lesson and the second lesson and the third lesson, it's very important for us to identify it, and it will simplify your work in knowing whether you debit or credit them. Okay, so these ones here, they're either going to be current assets or current liabilities. They will never be non-current, or they will never be equity. Okay, so let me just mention that. So the first one that we're looking at here is prepaid expense. What element is it? Well, this is a current asset. Okay, prepaid expense is a current asset because you've paid for an expense in advance, but you've not incurred that expense yet. So that means that that money that you have already paid still belongs to you until you have incurred the expense. That's why it's an asset and it's a current asset. Income received in advance or deferred income, on the other hand, is a current liability. And why is it a liability? Well, we saw in our first lesson that a liability is what you owe someone else. And we say that income received in advance is an income that we have received, but we've not provided the service or the product as yet. For that reason, that money that you have received does not belong to you yet until you have provided the service or the product. That's why it's a current liability. It's money that does not belong to you yet, even though you have received it. Accrued expense, like we said, still outstanding expense. You've not paid for this expense even though you have incurred it. This is a current liability because you have already incurred this expense and you owe that money to someone else. And remember, a liability is what you owe someone else, and this is what is known as a current liability. What about accrued income? Well, you have earned this income, but you have not received the money from the client as yet. For that reason, that makes it a current asset. Why is the current asset? Well, because the money belongs to you even though you have not received it yet, because you have earned the income, because you have either provided the service or the product. And now this is how they are dealt with. By knowing whether it's an asset or liability, then it's easy for you to know whether you debit it or credit it. Remember, in our second lesson or in part 2, we looked at the acronym that will help you remember what to debit and what to credit very easily. Okay, so what do we mean by current asset? Well, current means that something that is expected to be usable within the next 12 months. If it was non-current, it would be usable in longer than 12 months. And what do we mean by 12 months? Well, if I were to put it another way, it would mean that this is expected to be settled within the next 12 months. Okay, it's not a non-current asset. And we look at non-current assets in our coming lessons. But this is what accruals are. They're either current assets or current liability. So it should be easy for you now to identify what is a current asset and current liability when it comes to accruals and prepayments. So let's go into some examples in identifying what accrual or prepayment it is and also doing the journal entry for it. Here we go. The first one we have here, we are told that on 28 February 2021, the end of the financial year, the insurance account reflected a total of 10,000 rand. Included in this total is an annual insurance premium of 1,800 rand that was paid for the period 1 October 2020 to 30 September 2021. So what do we do here if we are asked to journalize this entry? Well, as we've seen with the other parts of accounting for beginners, we say that you have to identify what accounts they are for you to be able to know what you need to debit and what you need to credit. So what do we see here? Well, we see here an insurance account that is being paid. Another thing that is very important in accounting is dates. Dates are extremely important when you're dealing with anything in accounting. So here we are told that the 28th of February 2021 is the end of the financial year. So we make sure that all income and expenses are for this specific financial year. But if anything is being paid for that is outside our financial year, we have to account for it and do the entry for it. And we can see that that's the case here because if our year end is 28 February 2021, we've paid for an insurance premium until the 30th of September 2021, and it's included in the insurance account of 10,000 rand. That means we have to identify and calculate how much that is that belongs outside our period and remove it from the insurance account because we have not incurred that expense yet. Remember, if it doesn't belong to this specific period, we have not incurred it yet because we are not there yet. So let's calculate how many months that we've paid for that is outside our financial period. If our financial period ends on the 28th of February 2021, that means it started 12 months ago, which was the 1st of March 2020. So let's calculate how many months after the 28th of February 2021 we've paid the insurance premium for. Well, it's March 2021, April 2021, May, June, July, August, and September. Remember, we're also counting September because it's until the 30th of September. meaning until the end of that month. So bear in mind that it's for 7 months. Now what we'd like to do here is to identify what accrual or prepayment is it that we looked at in the previous slide. Can you identify it? Well, take a moment and try and identify which one it is. Well, I hope you've thought about it and you can identify that it's prepaid expense. Why is that? Because we are paying for an insurance premium that is outside our financial period. That means we are paying for it in advance. That makes it a prepaid expense. It's an expense that we are going to incur in the future, but we've paid for it now. So let's calculate how much that is that we've paid for in advance. And remember, we calculate the number of months that is outside our period. That makes it how many months we've paid for in advance. So we saw that it was 7 months from March 2021 to September 2021. That is 7 months. So we're going to take the 1,800 Rand, that is the annual insurance premium that has been paid, and we multiply it by 7 divided by 12, and it gives us 1,050 Rand. That is a prepaid expense. Now that we know that it's a prepaid expense and we have the amount, then we know that prepaid expense is a current asset. So if it's an asset, it increases on the debit side, as we looked at in part 2 of our lessons. So we debit prepaid expense, but what are we going to credit? We're going to credit insurance. Why are we crediting insurance? Well, insurance is an expense and expenses increase on the debit side. However, since it was included in the insurance account of 10,000 Rand, we have to remove it, and by removing it we are reducing the insurance premium. That means the insurance is decreasing and the expense decreases on the opposite side, which is the credit side. So we debit prepaid expense with 1,050 Rand and we credit insurance with 1,050 Rand, and the narration there is insurance premium paid for 7 months in advance. I hope it's made sense. Firstly, we have to look at the dates and see for how many months we've paid for in advance, and you also look at the information to be able to determine what it is. Let's look at the second example. Here we are told that the financial year end is 28 February 2021. Rent income includes rental of 4,900 Rand for March 2021. So what is happening here? Well, we have a financial year end. It's the same as the previous example, 28 February 2021. And rent income, remember this is income that we are earning. That means we are renting out our premises to someone else, and includes a rental of 4,900 Rand for March 2021. So that means this 4,900 Rand is an income received in advance. We have received an income in advance, or what is known as deferred income. So what is that? That is a current liability. We have received money even though we have not earned this money yet. So it's a liability. We're only going to earn it when the tenant stays at our premises in March 2021. And that is outside our financial period. So we're going to account for the income received in advance. And income received in advance, as I said, is a current liability. That means we put it on the credit side because we put our liabilities on the credit side. And what do we put on the debit side? Well, we put the rent income account. Why is that? Well, we know that income increases on the credit side. However, this income which is included in the rent income is not earned yet. That means it's not an income yet. So we have to take it out. And by taking it out, we're putting it in the opposite side, which is on the debit side. So we debit rent income 4,900 Rand and we credit income received in advance 4,900 Rand, and the narration here is rent for March received in advance. I hope you now see how you account for accruals and prepayments when you have a transaction and you have to identify it. Okay, let's look at the third one. Here we are told that the financial year end is 28 February 2021. Again, the water and electricity account of 750 Rand for February 2021 has not been paid, as the business still has until 5th of March 2021 to make payment. So what has happened here? Well, as you can see, we've incurred the water and electricity expense for 750 Rand for February 2021. And does February belong to our financial period? Yes, it does, because our financial year end is 28 February 2021. So what accrual or prepayment is this? Can you try and identify it? Pause the video here, try and identify it, and do the journal entry and see if you'll get the same answer as we do. Okay, I hope you've paused and I hope you identified it. This one here is accrued expense. Why is it an accrued expense? Well, like we said, the word accrued, we're switching it for still outstanding just to understand it. So that means we have an expense that's still outstanding. We have not paid for it yet because we're told that we have not paid for the February 2021 water and electricity account. So accrued expense is a liability because we have incurred this expense but we have not paid for it yet. That makes it a liability, and we're going to credit accrued expense. But what are we going to debit? We're going to debit water and electricity because that is an expense account and expenses increase on the debit side. So remember, if you've incurred an expense and you've not paid for it yet, you still have to account for that expense. That's why we are debiting the expense and we are crediting the liability, which is accrued expense, and that is with the 750 rand. And this is how it's going to look: debit the expense of water and electricity and credit accrued expenses 750 rand. The narration here is water and electricity for February 2021 not yet paid. Let's look at one more example. Here we are told that the financial year end is 28 February 2021. Make provision for outstanding interest on fixed deposit. The investment in fixed deposit was made on the 1st of July 2016 and it matures on the 30th of June 2021. So what is happening here? Well, we are told to make a provision for outstanding interest on fixed deposit. When you are told that you should make a provision for outstanding interest on fixed deposit, it means something has been earned but it's not been paid for yet. And in this case, it's interest on fixed deposit. And remember, a fixed deposit is what the company invests in, or it's putting money as a fixed deposit in a particular account and it earns interest on that money. So if we have to make a provision for the outstanding one, it means we have not been paid some of the interest on fixed deposit, or we have not accounted for it in this particular period as yet. And we're told that the investment in fixed deposit was made on the 1st of July 2016, which is some years back before this financial period, and it only matures after our financial period. Why is that important? Well, because that will affect how we do our calculation for the interest on fixed deposit. And we're also told that the following information was provided from the trial balance. Fixed deposit, Equity Bank, 12% per annum, 40,000 rand. That means we invested 40,000 rand. And interest on fixed deposit, 4,000 rand. That means we've already accounted for 4,000 rand. Now let's see how much it's supposed to be for this financial period. Remember, we've had this fixed deposit for the entire duration of this financial period because we're told that it was made on the 1st of July 2016 and it only matures after this financial period. That means we've had it for the full duration of the 12 months to the year ended 28 February 2021. So if we take this 40,000 rand, which is what we invested, and we multiply it by 12%, it's going to give us the interest on fixed deposit that we ought to receive or that we have earned for this specific period. And that gives us an amount of 4,800 rand. Now that we have the amount of 4,800 rand, we know that we've already accounted for 4,000 rand as we're told here. That means the balance, we still need to account for it. So the balance is obviously the 4,800 minus the 4,000 rand we've already accounted for, and it gives us an answer of 800 rand. And this 800 rand is what we have not accounted for or we have not received yet. That's why we're told to make a provision for the outstanding interest on fixed deposit. So if you've not accounted for it or received it yet as a business, what are we going to do? We're going to account for it now. And remember, this is accrued income, as you can see here. And why is it accrued income? Well, it's still outstanding income because we have not received this income of 800 rand yet. That makes it an accrued income. We have earned it, but we have not received it yet. So what are we going to do? We're going to debit accrued income because accrued income is an asset, increases on the debit side, and credit interest on fixed deposit. Interest on fixed deposit is an income account. So we're going to put it on the credit side because income increases on the credit side. And here is how it's going to look. We debit accrued income 800 rand because it's an asset, and we credit the income, which is interest on fixed deposit 800 rand. And the narration here is outstanding interest on fixed deposit. So you can see how we identify what accrual or prepayment it is. If it's an income that we have earned and we have not received yet, then you are easily able to identify it. If it's an expense that you have incurred, you have not paid yet, then you should be able to identify it. If you have paid for something in advance or a customer has paid for something in advance, then you should be able to know what prepayment it is. And I hope you're able to look at your information and determine what accrual or prepayment it is. If you have gained value from this lesson, consider subscribing to our channel, like this video, and share it to those who think it might help. You'll find the other parts of the series on accounting for beginners in the links in the description below. We also provide one-on-one lessons at reasonable rates. To find out more, you can visit our website at countards.com. You'll find the link in the description below, as well as our contact details, and you will see some of our other services that we provide on our website. See you on the next one.